So hi, I'm Rachel Brooke. I'm from Jim's Conveyancing, and it's a pleasure to introduce you to James Hawkins, the mortgage broker. Now, James, tell us about you and what you do.
Aha, I knew you'd ask that question. So I have been in finance for a long time through a range of different things. I started with Westpac. I was with Westpac for 14 years. And I've always been a good borrower, so looking after my own finances, and decided a few years ago to become a mortgage broker and help other people grow their wealth. Recently just finished a stint at Aussie Home Loans where I learnt a lot, and now I'm out as creatively titled James Hawkins Mortgage Broker.
I wouldn't have ever guessed.
And it's been amazing. The
And
referral networks are on fire.
Oh, good. And how long have you been out on your own now?
Well, really this year, so about 3 months.
Wow. Yeah. And how long were you at Aussie for?
I was at Aussie for 3 years.
For 3 years?
Yep.
Wow. So really about 17 plus years in the industry.
Yes, exactly.
Wow.
Thank you.
Amazing.
Well, good maths, Rach.
Thank you. So I guess really the whole point of what we're talking about is sort of more grey areas of finance, right? So obviously the stereotype behind borrowing and getting a loan is that you're only serviceable if you're full-time employed PAYG. So I guess what we want to talk about is different solutions for people that might fall into, could even be Jim's franchisees, like in my shoes, being self-employed. In terms of what we can do to maximise our borrowing capacity so we can have that Australian dream of owning a property. So one of the questions that I have, right, so for myself.
Yes, for you.
I'm self-employed. Now, I've had a look at my own serviceability via an online banking calculator. Now, when I did that, I just about wanted to cry and question why I've decided to run a business. Now, obviously, I'm transitioning over into a company myself, right?
Okay.
But part of that, for other business structures that might be self-employed or sole traders, are there any sort of ways that, for us to increase our borrowing capacity into that sort of, superpower ability of what a PAYG candidate going to a bank could get?
Yeah, it's very interesting because a lot of employers who have their own business, they're employing a whole lot of staff, and the staff are all on a salary, and they can all get a loan, but the actual boss is paying all the salaries, can struggle because of the various scenarios around their profit and loss and all that sort of stuff. So that's probably one of the most interesting things that people who own businesses get frustrated with. So all their staff have got home loans and they don't. And then the other thing is we talk about, for self-employed, there's always financial planning and tax planning and all that sort of stuff, but we don't often look at finance planning and lending planning. So there are things that someone self-employed can do to get organised in advance. Now, the banks have recognised this as well. So they've probably in the last few years actually, I won't say loosened their policies on self-employed, but they've created different policies to help self-employed, as long as you can prove the numbers are there. So in the old days, pre-COVID, I guess, banks wanted to look at 2 years worth of financials, either use the lowest or the average, and for whatever reason, they may not have folded out nicely for a bank's calculator, and it would frustrate the owner. So as I said, the banks recognise this. So now there are actually several different ways that someone self-employed can get a loan. If you have a company and you pay yourself a salary and you've done so consistently for 6 months, then some banks will consider you as a PAYG employee. And that's it, full stop, nothing else to do. There are some that go, okay, so this person is in business. The last 2 years, they may have paid themselves, however, dividends, salary, money out of the business, whatever. If their last two personal notices of assessment, so the number you're telling the tax office that you earned, add up, then you can get a loan just based on that. No other documentation required. Some other banks are saying, okay, just show us how much you've paid yourself from the business into your bank account for the last 6 months or a year, and they can annualise that. And then, of course, since COVID, a lot of businesses have recovered. So a lot of banks are looking at just 1 year's financials. So if you, for some reason, you were locked down, you had a disastrous couple of years, they will take the 2023 financials as gold. And then there are some other, I guess, what you call non-bank lenders who recognise that life can get in the way. They'll actually lend you money based on your last 2 BAS.
Oh, really?
Yes. Now, sounds good. There's a risk for them, so their rates are a bit higher and stuff like that. But the idea of using a broker is they'll find out the way that works the best.
So obviously, the riskier, the more lender's mortgage insurance you'd be paying,
not necessarily mortgage insurance, but an interest rate, I guess.
Right.
And maybe a risk fee or some sort of insurance fee. Having said all that, I think it's just better to plan. So a lot of self-employed people who are doing well, they're like, wow, I'm doing well, I'm going to go buy a house. And for whatever reason, the reflection of doing well actually doesn't appear in their statements or on their tax returns or whatever else. I'm not saying probably no businesses collect cash anymore, but there's some really wealthy people with cash who didn't declare anything and they couldn't borrow anything.
Yeah.
So people go and buy houses without getting their ducks in a row first, which is when all the dramas start. So I like to, for a business person, get them at least 6 months before they're thinking of buying and planning and going, okay, so what do your financials look like? Can you pay yourself a consistent salary for the next 6 months? Or can we look at your current tax setup or structure and work out how that can be better for the next financial year? So, I don't know, did I answer your question?
Yeah, no, absolutely.
Can I get you a loan now?
Maybe. So like I mentioned, right, I'm going through a company restructure myself, so I'll be putting myself into a salary.
Yep.
Is there any other tips, like for other franchisees or business owners, whatever, sitting in my shoes that aren't on a consistent PAYG salary? Is there anything else that we can do to maximise our borrowing power other than just putting ourselves on a salary?
Yeah. So I guess, well, the first thing, if you're going to change structures, so from a sole trader to a company, make sure you keep the same ABN. It's probably the tip number one. As soon as you change ABNs, it's probably one of the first things banks look at for self-employed is how old the ABN is.
Okay.
It's a month old. They're generally like, whoa, too new in business. So we like to be able to show some consistency.
How long does an ABN need to be valid for?
Look, normally 2 years.
Okay.
Some banks will operate on 18 months. Again, some are on a year.
Okay.
The higher the risk, the higher the interest rate.
No, it makes sense.
Yeah, banks, I guess, love 2 years of consistency for self-employed people to get the best deal. In terms of things that can reduce your borrowing capacity, other debts is one thing, and debts in your personal name even more. So if you had a car loan and you're in business, possibly having that car loan in the business name, not your personal name, would increase your borrowing capacity. There are some lenders that are happy to count your car loan debt as just part of your P&L, not an extra debt. It's just covered by the profits of your business.
Okay.
So that's a pretty good one. And yet, having said that, there are some banks that will, even if it's in your name, but it's for your business, they're okay with that. So probably keeping your debts low. A lot of business people put, say, phone expenses and car expenses through the business. So I'm not a tax expert, so that would have to be worked out with your accountant.
Yep.
But the lower your expenses of living, the more you can borrow. Right. There are obviously minimum standards depending on what you earn and all that sort of stuff. And yeah, generally I think just making sure you're paying your bills on time, so your credit score's good.
Yep.
Because when we check credit, we check your personal and your business. Don't apply for too much finance.
Okay.
If you apply for multiple lots of finance and zip pays and afterpays and overdrafts and all that sort of thing, the algorithm goes, whoa, desperate,
Yeah.
lowers your credit score. The bank goes, whoa, desperate. And then the bank might go, oh, how come you applied for loans with this, this and this and they didn't give you a loan?
Right.
Or did they give you a loan? Or they might even say, well, if they didn't give them a loan, we're not going to give them a loan. We don't even want to know why. So credit score is important. Not missing bills. Telstra bill. Such a minor thing, but it can be such a ruthless interruption to a credit score. Not applying for too much finance. Having said that, getting a credit card and paying it off regularly helps your credit score. One missed payment creates a disaster for your credit score. So that's one thing. Not borrowing too much, particularly not on your personal name. What else? What else could help you out?
I guess.
Yeah, I guess we've got to work out the way to maximise your income or profit.
Obviously, what we so when banks have a look from a serviceability and a borrowing power perspective,
Yep.
obviously numbers matter, and
Yep.
same with debt management. What about character in itself? Is that actually a thing where so my parents used to work in banking, right?
Yep.
And they really preached, well, it's really down to your character, right? In terms of, showing honesty, integrity, and things like that. Does that really matter as much when applying for a loan? Because obviously that also ties in with your ability to pay bills on time. So obviously it doesn't always just come down to money from, at least so my parents they used to work in the banks, right? And part of what they told me, as a prospective first home buyer myself, when looking at purchasing and getting the loan, is that it's not just money that just matters at the end of the day, but also more, character and, integrity, and showing that in, obviously in your profile when applying for a loan. And I guess that also entwines with paying your bills on time and things like that. I think it was a term that they mentioned, it was on maintaining a good credit score.
Yep.
Can you just explain what that is?
Yeah, well, I think character is probably what you're talking about as one of the 5 C's of credit. There's character, collateral, capacity, the conditions, and the capital that you might have.
Okay.
So in terms of character, credit score is one of your main parts of your character. So are you a person who pays bills on time? Are you a person that is a good borrower and a good repayer? Are you a person who's always looking for credit? It sort of says something about desperate character. But also part of character is your stability of where you've lived and your employment. So if you're getting a job every 3 months, then the bank's like, oh, okay, wow, this is they're a bit random. So you might have to tell a story about why that happened. There could be some circumstances that the algorithm doesn't understand.
Right.
And then there's also the part of your characters where you've lived. So in any loan application, generally every bank wants to know for the last 3 years where you've lived and where you've worked. So, and if you've lived in 12 places in the last 3 years, then there might be some questions about what is going on with this person. They're a bit unstable. And I guess every bank has a calculator that spits out a character score. Definitely the main one is your credit score, for sure.
Definitely. And I guess basically from everything that you've told me in terms of, applying for a loan and getting an idea of your borrowing capacity isn't just as simple as searching up the online bank calculators that are available via the bank's websites. There's obviously more to tell. And that's why seeing a mortgage broker is more ideal, because you're going to get more of an actual picture in terms of capturing those different factors.
And we've got to get a loan for your specific circumstances. So a bank's calculator, mind you, the bank's calculators are really a marketing tool. And I will say they're getting better at capturing more information. A few years ago, you just type it in and it's go, hey, you can borrow this. But everyone's circumstances are a little bit different, and there's a few things in the bank's calculators that probably people aren't aware of when they're filling them out. So you've got your income. Now, I've asked so many people what their income is. Now, half the time they don't know if that includes super or doesn't.
Okay.
So you can't use your super as part of the bank's calculator. But let's just say you're on a package for 100,000 and you type that into the bank's calculator. You're going to get a result, but your salary is actually probably 90.
Right.
So already you've got a 10% less borrowing power, I suppose. And then you also might be someone who earns a lot of overtime or commissions or allowances for certain things, like a pilot might have an allowance for travelling overseas or whatever. They're all treated slightly differently by the banks. So you might go, oh, I earn 100 grand overtime and chuck that in. But some banks only count 80% of that. If you're an emergency services worker, some banks might count 100% of that. So already when you're typing your income into a bank's calculator, you might not be typing the right number.
Right.
I guess. That's the first thing.
Since speaking about overtime and all of that, so obviously we talked about those on a salary. What about those that are casually employed? Is there any way for casuals to be treated, if not the same or at
casual,
even higher?
A lot of the time, casual depends on the length of employment. So I just got a lady alone, has been a casual barista for 14 years. Same place, pretty stable. All the bank needed was her last 6 months of casual salary times by 2 as her annual salary. But all banks are different. So some banks, if you've been a casual for 1 day as a barista, for 1 day as a barista at one place, but the last 14 years at another place, that's okay.
Okay.
But some want you to have been at that place for 3 months, some want you to have been at that place for 6 months, some want you to have been at that place for 12 months. If you were a butcher for 12 years and then you became a carpenter, they're probably not going to be favourable with that either, because there's no sort of guarantee that you're any good at being a carpenter.
Is it because, like, for those that have spent many years in the same industry as a casual, is that just purely based on the fact that if they're like labourers, for example, they'll take up a lot of different contracts with a lot of different employers for many years in a skilled role.
Yeah. So if they're, sorry.
No, continue.
Well, if they've been a labourer for a long time and they're not having big gaps in employment, then they're obviously a labourer who knows how to be a labourer. So the bank's more confident in their character that they've got a new casual labouring job, but they've been doing it for 10 years. So there's not a high risk that they're going to all of a sudden not have any work, no income. Okay. So it's more about, for the bank, the risk of the next 30 years of the loan.
Makes sense.
Yeah. So, and again, every bank has a different casual policy. Right. And it also depends on the time of the year. So, for example, now we're up to February. So most people who've been working have about 7 months or 8 months of income on their payslip. So bank can go, okay, they've been working 7 months. Let's do the maths and work out what the annual salary looks like. If you're applying for a loan in August, then you've only got 2 months on your payslip. Right. So they look at last year. Now, last year you might have had a terrible year. For whatever reason, you're casual and you got sick and you couldn't work or whatever, and then so your borrowing capacity is much lower, so you're better off waiting 6 months. But as I said, every bank's got a different policy. So the idea of using a broker is they can look at your personal situation and work out which bank fits the best for what you want.
There's really no blanket approach, and that's why, seeing a broker that has 40 or 50 different banks on their panel is a good thing, because there really isn't no one size fits all when it comes to serviceability, from what you've told us, from so many factors really. So, and I guess like the real trend of a theme that I wanted to entwine with all of these videos that we've done is the belief that I'm a young person
Yep.
and I'm just not even going to bother trying to get into the property market because it's just not achievable.
Yeah.
So obviously we talked about, the fact that myself being self-employed, I've
Yep.
had a look at these online bank calculators. You've told us there's so many different
Yep.
factors that come into play. But other than that, with being actually educated on the fact that go see a broker because they might be able to tell you a different story, overall, is there something that perhaps even any sort of tips that you could give, it could be for mum and dad to help me or anything in general in order to help me get there to get into a property?
It's almost like you were in my office yesterday. So I had a young fella, he texts me and he goes, oh, look, I'm a friend of Susie's. You just got her a loan. I'd like to have a chat about my first home. And I went, okay, no worries. Sent him the link, booked in to my diary. And about an hour before, he texts me, he goes, can we cancel today's meeting? I just want to get more organised with my life and everything before I decide on a home loan. And I want to get a plan, I think he said. I said, that's my job, to help you with a plan, to set you up and point you in the right direction about where you're going. And then I heard nothing. And then about 10 minutes before the meeting, he goes, okay, all right, I'll meet you. I said, great, it's just a chat. All we're going to do is find out what your situation is. So he got on the phone and he turns out he wasn't confident in himself because he'd been to Europe, spent a lot of money, he'd been paying down his Europe holiday trip debt, so he hadn't saved anything. But he had a good income, so he had no savings. And then I explained to him what the different options are for a first home buyer who's got a good income, who wants to move out and stop paying $2,500 rent a month, what the options are. And I explained to him about parental guarantor. So
Right.
if your parents have got equity in their home and they want to share some with their child, you can actually borrow 106% of the value of the property.
Wow.
So the property value plus the stamp duty, as long as you can service that with your income. And the parents are basically guaranteeing that 20% deposit. Parents don't have to put their hand in their pocket. That they really just need to say, yes, we love our child and he can have some of our equity for a short time until you grow your own, I guess, 20% buffer. So, and all of a sudden, at the end of the call, he goes, oh my God, I didn't even know a guarantor existed. He goes, so I can buy a house way earlier than I thought I could. I said, you could actually do it now.
Oh, wow.
So I said, don't go buy a house on the weekend, please. Let's get it planned and organised first. So you just actually mentioned that's exactly what happened. The other thing, banks generally like someone who's buying their first home to have showed they've saved 5% of the value on their own. Now, so a $600,000 property, that's $30,000.
Right.
For some people, they're like, oh, good, I can save that in 5 months. Some are like, oh my God, that's going to take me 10 years. There is now one bank, and once one bank does it, others follow suit, who will actually accept a parental gift of 5% as the savings.
Oh, wow.
Especially if you've been renting, because they'll actually take your rent payments as saving.
Right.
So all of a sudden, the doors now open to a lot of kids I say kids because most of my clients are my kids' age, like your age, and they are on good income and they've been spending money on rent and they can't save, or they had a holiday and they've been paying it off diligently. All of a sudden, they can buy a place and get out of the rental market. Because most people who come to me at that age, their rent's gone up in the last year. And they're like, I could get a mortgage and pay myself rent, basically.
And pay less than the rent as well.
Pay less.
Yeah.
For some, it's less, yeah.
Absolutely.
Yep.
And so part of, so for mums and dads out there listening and who might consider, oh, well, this is actually a thing where I can be a guarantor. Is that throughout the lifespan of the loan?
No, so it's not. So the guarantor what they're guaranteeing is not their whole house. So they are putting the equity of their home on the line, I suppose, but only a small part of it and how it relates to their kids' setup. So I usually say it could be around about 100,000, and that's only until the child can get equity of 100,000 in their own home.
Right.
Then they can refinance their parents out of the whole arrangement. Now, how do you get that 20% buffer yourself? Well, you buy a property and generally the property values go up. They have, since 1836 in Melbourne, they've always gone up, no matter what global crisis or anything that Channel 9 News tries to tell us about.
Yep.
And of course, you're paying your mortgage off, so it's coming down as well. So I always say to my customers, your mortgage will generally always come down and your rent's generally always going to go up and your property's generally always going to go up. So it makes sense to get your own.
Yep.
So, yeah, the parents actually sign what's called a limited guarantee. They know exactly what amount they're signing for, and we can usually work on a strategy on how long till they're out of it. Some banks will let you put all your kids on. So you can have your own home, your own loan, and then 3 other guarantees if you've got 3 other kids, all against your property. Now, the worst, I do meet the parents separately because I have to explain to them. So I know their child doesn't have a gun to their head or something, they're forcing them to do it. The absolute worst that can happen is this: if their child defaults on their loan, and then they can't sell the house to get enough money back to pay the loan, then there might be a shortfall. Let's say they bought a house for 500,000 and they borrowed 500,000. And then for some reason they couldn't pay their loan off. They got it down to 490, couldn't pay their loan. So they go to sell the house and they could only get 450 for some reason. So they're $40,000 short. The bank says we want $40,000. Now, the parents can actually just hand $40,000 over.
Right.
It's all fixed. If the parents don't have any money, or the parents can't borrow any money, ultimately the bank can sell their house, the parents' house, to get their money back.
Right.
I've never heard of it happening. So the risk is quite low.
Right.
But I guess that's what a guarantor is. I've only ever had one parent who said, no, I'm not going to guarantee my child. So they didn't trust their own child to pay their mortgage. So most parents are happy to do it. It depends on their situation as well. But yeah, they're not committing their whole home for life.
Yep.
They're only committing a small part of their equity for 1, 2, 3, 4, 5. Depends on how many years. And if they've got a vested interest in their child paying off their loan, they're probably going to be giving them a nudge.
Yeah, definitely. And just a last question about that available solution. Does it actually waive the lender's mortgage insurances?
You sound like you've done your homework. So yes, so mortgage insurance is very interesting. So some banks, most banks want a 20% deposit. And then anything less than that, I won't say they get worried, but they want to insure themselves. So mortgage insurance is the only insurance in the world where you get to pay, but you're actually insuring someone else, the bank. And it's big, and it's something we try to avoid. So if you've got less than a 20% deposit, there are some banks now that are doing 15%, which is helping out. There's government guarantee schemes which can allow for only 5%, or in the case of a single mum, 2%. But if you've got a guarantor, then all of a sudden it's 80%, game on, no mortgage insurance at all. And then, of course, there's other professions where you only need a 10% deposit, like nurses, doctors, allied health people, physiotherapists, all that sort of stuff. And in fact, another bank's just brought out a policy. If you're a career banker, you can get a bank with that bank. It doesn't matter who you work for, but you can get a loan with that bank with no mortgage insurance.
Really?
So guarantor loan, absolutely not. You get no mortgage insurance. You get the best rate because it's the bank figures this is as secure as it's going to get. Mum
Yeah.
and dad are guaranteeing the kid. So
it actually,
they love guarantor loans.
absolutely.
Yep.
So it actually has the effect of potentially maybe waiving the LMI, but also as well bringing the interest rate down.
Yeah, so they can borrow more.
Because
So they don't have to use as much money for LMI, and also the rate's lower, so they can borrow more.
Yep.
Yeah. So
it sounds like one of the biggest solutions out there for kids lucky enough, mum and dad will do that
for them. Well used, particularly where we are in the eastern suburbs of Melbourne.
Yeah.
A lot of kids with high incomes and a lot of parents who bought their home for $60,000.
Yes.
It's now worth millions. So it's a really good option. Yep.
So it talks about so one of the solutions is for mum and dad to be a guarantor on the loan. Is there anything else that young people can consider to get into the market?
Yeah, I think so. The other one, I often get asked by parents who I'm doing the loan for, how can I help my child get into the market? And one of them, what's commonly termed as rent vesting, I like to say you can help them get a home while they're living in yours. So there are some banks, as long as mum and dad are prepared to sign a stat dec to say that the kid's living at home rent-free, they can live at home rent-free and then buy an investment property and collect rent from a tenant.
Right.
So all of a sudden, they have no rental expenses. They have very few expenses because they're living at home, and they're collecting rent from someone else. So all of a sudden, their borrowing capacity is much higher, and they can get into the market. The only disadvantage of that is you don't qualify for any of the first home buyer benefits, which would be stamp duty exemption.
Yep.
So you might be having to pay $20,000 or $30,000 stamp duty, but what's the sacrifice of not paying that? If you stay out of the market for 5 years, you could have lost 30, 40, 100 grand in the property value. So
easily.
Yeah, easily. And you can also double that with a guarantor loan as well. So you can live at home, rent vest, and use the parents as a guarantor at the same time.
Oh, wow.
Double bonus.
It's like a triple dip, really.
Yeah, so I just had a girl who did that. She's living at home with mum in the same home that mum used as a guarantee. So she bought an investment property and she's getting $550 a week rent. She did pay the stamp duty, I think it was $25,000. But
long term, though, she's in the market.
Absolutely.
She's easily going to earn that money back.
Yeah.
If not, depending on the area, less than 6 months sometimes as well.
And I sort of take a similar attitude with mortgage insurance as well. I mean, you might have to pay $10,000 mortgage insurance, but what is the cost of not buying that property now?
Exactly.
If you wait a year, that 10 grand could be gone as well.
So going back to online bank calculators, why they're not actually indicative of your real borrowing capacity, how do they actually work? Yeah,
so I think, as I said before, they're more of a marketing tool, and getting your income right is a bit of a challenge. But also there's all the other things that reduce your borrowing capacity that you may not think about or know about when you're typing numbers into a bank's calculator. For example, your HEX. If you've got a university debt, HEX is considered a loan by the bank, and whatever your monthly repayments are, they are viewed by the bank as a monthly repayment on a loan, and that reduces how much you can borrow on a home loan. A lot of people don't know how HEX is calculated. They just see it just add up every year on their statement. So putting that into a bank's calculator is tricky. Then there's a whole lot of other expenses that aren't considered normal living expenses. So there's normal living expenses. If you earn 100 grand and you're single and you live in the eastern suburbs of Melbourne, then there's a minimum expectation of how much you spend. But on top of that is things that are considered luxuries, I guess. Private health insurance is one. So a lot of the times I ask customers, have you got private health insurance? And they think it's a health question. And they're like, yeah, I spend $300 a month. But I say, sorry, it's actually a finance question. It means that's another $50,000 you can't borrow.
Right.
So I have known clients to cancel their health insurance to get a home loan. Things like strata costs. So every bank now has recently just changed. If you're buying an apartment, your borrowing capacity can be reduced severely by the strata costs of the apartment. So if it's $400 a month in strata costs, that's $400 you can't use to borrow, which could be another $70,000 or $80,000. Childcare, private schools, second holiday homes, if that's where you're up to in your life, they're all things that can reduce your borrowing capacity. They aren't necessarily numbers you'd think of typing into the bank's calculator. I recently had two brothers who had gone into the calculator and worked out they could borrow $1 million together, but they hadn't taken in to account that they both lived in different households, they both had different rent. One of them, his name was the only one on the rental contract, so he couldn't split it with his mates because it was just his name. Lots of things like that. So great idea to use a couple of bank calculators to get an idea, but honestly, come to a mortgage broker, and any mortgage broker in 10 minutes should be able to work out a more realistic number of what you can borrow.
So alternative solutions to getting into property.
Yep.
Another term that's come up, which I'll be very honest with you, I'm not as familiar with, is what, so you can actually apply for super fund loans. So I was just hoping that you could shed some light on that.
Yeah, so good question. Particularly at the moment with interest rates rising, there are some investors that have reached their limit and they see being able to invest in property in their super as a way of getting maybe another property. So to be able to invest using your super money, you need to have a self-managed super fund. Having said that, you can get a pre-approval to buy a property without having the fund set up yet, but ultimately you would have to have it set up. And there are quite a few lenders now that a lot of the banks went out of super fund lending, but there are a lot of, I guess, non-bank lenders who see there's a good opportunity there. So you can set up a super fund. If your super fund has money in it, there's your deposit, so you don't have to save for a deposit. You've been probably saving all your working life or however long you've worked for. And then you get a loan to buy the rest of the property. You don't have the same trappings around living expenses because your super fund doesn't have any living expenses. So that immediately goes. So that increases your borrowing capacity straight away. Some lenders would like to see a history of money you've been putting into your super fund for the last 2 years. Some will take your current payslip and go, if that's enough super plus the rent you're going to get from your tenant, because you can't live in a place you buy in your super fund. It has to be an investment.
Okay.
You can never live there. Check with your accountant and your solicitor. But it's actually a very easy way of allowing you to buy an investment property using your super fund. There's, apart from the legalities of having the super fund set up and making sure your strategy's right, which you'll do with a financial planner or an accountant, the actual banking process is quite easy. And again, like all other things in home lending, every bank's policy is a little bit different. Some want you to have some money left in the super fund, say 10% of your fund left. Some only want you to have 5% of the loan amount left in your fund. Some don't care if you've got no money left in your fund. For self-employed people, you might be able to put, on June the 30th, put, say, $25,000 in your super, and then on July the 1st, put another $25,000 in your super, and all of a sudden you're putting $25,000 a year into your super. And you can borrow money based on that. So a lot of the time, it's having those funds to buy an investment property. Your 20% might already be in your super, just sitting there. But again, any broker can help you with a super fund loan. but you need to have your strategy, actual self-managed super fund set up, and then the strategy behind it
Right.
set up.
Now, James, we've spoken about so many different things today, and really I think we've broken down the misconceptions behind bank calculators and their reliability and their accuracy, and we've discussed many different options and ways and how really there's quite a lot of flexibility in terms of getting into the market. But I just want to thank you for all of your insight, and I've learned a lot myself as well, and it's definitely, even for myself as a prospective home buyer in the near future, hopefully, I'll take on some of those things on board myself as a self-employed person. And thanks so much for your time. And you can contact James. He's James Hawkins, the mortgage broker.
That's it. Just creatively named James Hawkins, mortgage broker.
And you can find him, no doubt, at his website at...
It's www.jamesthebroker.com.au. But thank you for having me. It's great to be down here at Jim's place, and I've really enjoyed it. So thanks. I appreciate the invitation.
All good, anytime.